Alright, welcome to the Explainer. So if you've ever tried scalping gold, you already know it can be an absolute roller coaster, right? Well, today we're going to break down 3 really powerful rules-based strategies that'll help you navigate that chaos with a whole lot more confidence. Yeah, fast, aggressive, and extremely unforgiving. I mean, that pretty much hits the nail on the head, doesn't it? It perfectly captures that feeling so many traders have. You make just one wrong move and bam, the market just flips on you in an instant. So the big question is, how can you actually scalp gold with a clear, repeatable plan? Look, the secret isn't trying to avoid the volatility. That's impossible. The key is to have a solid mechanical framework that helps you navigate through it. It's all about trading with a plan, not just gut feelings or emotions. Okay, so here's our roadmap for today. We'll kick things off with the gold scalping challenge. Then we'll dive into our 3 strategies: the reversal, the continuation, and the shift. And we'll wrap it all up with a handy little trading rulebook. Let's get into it. Alright, section 1, the gold scalping challenge. Before we jump into any strategies, we've got to understand gold's unique behavior. Trust me, it's a different beast altogether. So what makes gold so different? Well, for starters, whether you're trading it as XAU/USD in forex or as a tokenized asset, it's known for its huge volatility and deep liquidity. But here's the real kicker. Gold has this incredible respect for major technical zones from higher time frames. We're talking about key areas like order blocks and fair value gaps. It pretty much just swings back and forth between these specific areas. And that is the secret we're going to exploit. So this brings us to the absolute core principle of everything we're going to talk about today. It's simple but crucial. Use higher time frames for your analysis and then drop down to lower time frames for your execution. So you'll spot your main areas of interest on, say, the 15-minute or 1-hour chart, and then you'll zoom right into the 1-minute chart to nail your entry. This 2-step process is everything. Okay, before we get any deeper, let's lock down a couple of key terms. First up, the order block. So what is it? Just think of it like a footprint left behind by the big institutional players, the smart money. It's that key price zone, often the last candle before a massive price move, where they placed huge orders. It acts like a magnet because price often loves to come back and revisit that spot. And the second term you absolutely need to know is the fair value gap, or FVG for short. This happens when price moves so fast and so hard that it kind of leaves a void, an imbalance in the market. It's an area of inefficiency. And you know what? The market hates inefficiency. So just like order blocks, these gaps act like powerful magnets, pulling the price back to fill that void. All right, let's get into the good stuff. Section 2, Strategy 1, the reversal. This one is all about catching that powerful turning point right after the market does one of its classic fakeouts. So this is a really clean 4-step process. First, on your higher time frame, like the 15 or 30 minute, you're looking for a liquidity sweep. That's where price dips below a low and then powerfully reverses, creating a break of structure. Step 2, you mark the order block that kicked off that whole move. Then you just wait for price to come back to that order block. And finally, you drop to your lower time frame and look for that last piece of confirmation, maybe something like an inverse fair value gap. Now, once you get that confirmation signal, you've got a choice to make about your entry. You can jump in right away with a market order. The good thing, you're guaranteed to be in the trade. The downside, your risk to reward might not be the best. Or you can be more patient and set a limit order for a better price. The pro there is much better risk to reward. But the con? Well, you might get left behind if the price never pulls back. So let's put it all together into a clear set of rules for the reversal. For your entry, you're either going in right away at the next candle's open, or you're setting a limit order at the top of that confirmation signal. Your stop loss? Simple. Just place it right below the most recent swing low. And for your take profit, you're going to target the nearest pool of liquidity or a key level from your higher time frame analysis. Simple as that. Okay, on to our next one. Section 3, Strategy 2, the continuation. This is for those times, and we've all been there, where you miss the big reversal, but you still want to safely hop on a trend that's already moving. The whole logic here is really about patience and confirmation. First, you need to see a strong, confirmed trend on your higher time frame. Let's say the 1 hour. You're looking for at least 2 clear breaks of structure. Once you have that, you find that key demand zone that caused the last big push. Then you just sit on your hands and wait for price to pull back into that zone. Only then do you drop down to your lower time frame to hunt for your entry signal, which in this case is a market structure shift, and then a bullish breaker block. And the rules for this one are super specific, which is great. The entry is very mechanical. You set a buy limit order right at the highest point of that breaker block. For the stop loss, you'll place it just a few pips below the most recent swing low. And for your take profit, you guessed it, you're aiming for that nearest pile of liquidity or another key higher time frame level. It's a really structured way to get into an existing move. And now for our third and final strategy, Section 4, the shift. This one is for trading those huge, major changes in market direction. This is the setup you look for when you think an entire, long-term trend might finally be coming to an end. Now, this is probably the most patient strategy of all three. You start on a high time frame, like the 1 hour or even 4 hour, and you're looking for a really strong, established trend, meaning 3 or more breaks of structure. Then, you wait for that first major crack in the foundation, a change of character against the trend. Inside that counter move, you're hunting for a fair value gap. That becomes your golden zone. Then it's back to waiting for price to pull into that FVG and give you a confirmation on the lower time frame. And check out the rules for the shift. You're probably noticing a pattern by now, right? Just like with the reversal strategy, you've got 2 options for your entry. You can get in immediately after that confirmation forms, or you can place a more conservative limit order. Your stop loss goes right below the most recent swing low, and your take profit aims for the nearest buy-side liquidity or a key higher time frame level. See? The core logic is consistent. Wow, okay, we have covered a ton of ground here, right? We've gone from reversals to continuations, all the way to major market shifts. So let's pull this all together into a super simple, quick reference guide. Think of this table as your ultimate cheat sheet. When you're looking at the charts, you can just glance at this and quickly see which setup might be playing out. You've got the reversal, which is all about that liquidity sweep. You've got the continuation for confirmed trends, and the shift for when a strong trend starts to break down. Each has its own key setup and its own best timeframes to watch. And this might be the single most important thing to remember from all of this. The goal is not to be trading all the time. A strategy is just a map. The real skill, the thing that makes all the difference, is having the discipline to wait patiently for your specific, high probability setup to show up. Seriously, great trading is like 90% waiting and 10% action. So look, the strategy is the map, but discipline is the driver. We've given you the map today. The real question is, are you ready to take the wheel? Thanks for watching.